May 28th, 2024. Something to keep in mind is that on trading range days, you can often get vacuum tests of the open of the day late in the day. And that's pretty much what we got today. You can see this whole thing ended up being a vacuum test of the open. And the reason that can happen when you get such a strong move is because traders see that most of the day was a trading range day. And when most of the day is a trading range day and then you get a breakout, odds are it might have to come back. And I think 66 was your big hint that it was still a trading range day rather than a bear trend day. Because if this is a big bear trend and this is going to be a successful bear trend, bar 66 should not happen. So with how big bar 66 was and the context of how the rest of the day was a trading range day, you have to immediately start thinking, what are we going to do? And I thought there was, we were going to test magnets like the 56 close, because 54, 55, 56, three straight bull bars. So the bulls who bought here and scale and lower should make money. You can see that they were able to. They were within one tick on 74 high. Thought we might have to, if bulls were lucky. I thought this was unusual to get this big of a thing or this big of a move that late in the day, but it does happen. I thought we might have to test the bar 50, 51, or sorry, the bar 50 close, because 49, 50 consecutive bull bars. And I wasn't even really looking at the 33 close anymore because I thought that it was so far away. But you can see at the end of the day, we ended up getting such a big vacuum test up that we actually got to that area. Another way to look at it is you can see they have the spike and then the channel, which is a wedge channel, 1, 2, 3, and we got a measured move up of that, which is where the exact high of this rally was. So you can look at it as testing reasonable magnets, or you can just look at 77 simply as a breakout attempt above a wedge and hoping for the measured move up. I think either way is pretty reasonable. But I don't know how much, of the rest of or how much this is going to have a big influence tomorrow, because I thought that 3 straight bear bars was really unusual to get this strong of a breakout. So we might have to test back down into this area tomorrow. But still really strong enough for a second leg up, probably going at least a little bit higher. Another big thing, actually, I'll get to that later. Bar 1, a bull bar, but a big tail on the top and the bottom. There's probably buyers below. It's a bad low 1 short for the bears. The bulls are hoping that, I don't really count this day. I just kind of ignore it. You just usually do that with the half days. But you can argue gap up from here to here. So bulls consecutive bull bars, probably always in long, but it's not all that clear yet. Bar 2, big tail on the bottom. So bulls, what did they do? They bought below 1, knowing that that bears would not be interested in selling below 1. So they bought here, and they scalped out around the open of the day for 3 points. You can see why not the open of the day, they closed at bar 1, because if it was a big gap up and then a follow through bar, we should test back to this price. So they buy below bar 1 and they use the tail on 3 to scalp out. Some traders might have hoped that, while buying during 2 was going to turn into a really big bull bar closing near its high, but it's not all that likely that that's going to happen. So a lot of traders or limited order traders are just going to scalp out. Bar 3, a bear bar closing near its low. Good for the bears. Some traders would argue 1, 2, and 3. The lows are some sort of parabolic wedge on a lower time frame. But regardless, it's a good bear bar closing near its low. It's probably a trading range open, but we're probably going at least a little bit lower. And if we do start to rally, or let's say bar 4 is a bull bar, we're probably going to get back to the 3 close because it's a big enough bar that should happen. Bar 4, follow through for the bears, but a tail on the bottom. It's really not all that ideal. If you sold below 3, you were able to make pretty much 4 points, a little more than 4 points, and that's what most traders scalped out with. So that's your hint that the scalp on the day was probably more like 4 points instead of 5 for the opening range, is how small the move was from 3 to 4. I think that, in general, a lot of I lost my train of thought. Anyways, bar 5, an inside bar, a low 1 short for the bears. Do you sell below bar 5? I probably wouldn't. What I was going to say was 80% chance of a minor reversal lasting at least 5 bars in the open. And we haven't really had that yet today. So do I think this is going to be a strong bear trend from the open? No, probably not. It's more likely going to be a trading range open. When you have inside bars, which are low 1s, which usually lead to retests before any sort of trend resumption, can also act as final flags. There's probably going to be buyers below bar 5. You can see bar 6, we traded down, and then it got bought up. Why? Because traders who sold below here felt lucky to make their 2 points, and so they just scalped out. And anyone who didn't scalp out did below 6 because 6 is not a good bar to sell below. You're selling, 1, 2, 3. So 1, 4, 6, possible wedge, probably, I guess parabolic wedge, probably buyers below. Does that mean you sell above 6? Or sorry, does that mean you buy above 6? No. But it's not logical to be selling down here. We're probably towards the bottom of a developing trading range since we are around the open, or we're on the open and should be a trading range open. Outside up, bar 7. It's a good bull bar. Big tail on the top, big tail on the bottom. Probably sellers not too far above 6, but again, buyers below. So I see 7, and to me, that confirms this is a trading range open. So now what am I looking for? Well, when you have a trading range open, you should be looking for a small bar near the top to sell or a small bar near the bottom to buy. You don't really want to be taking big bars trades for the most part. 8, follow through for the bulls, but not as good as it could be. It's another inside bar, another high 1. There's probably buyers below, and there's probably sellers not too far above, but I don't really want to buy above 8 because you're buying in the middle of the trading range. So, if you're buying pretty much the exact middle tick of the trading range or pretty close to it. So, it's really hard to take the middle of the trading range seriously for a long time. But it's really true. Just don't trade in the middle of the trading range. So, what I used to do was I would just draw whenever I would see a trading range like this. I would just draw, and then I would put a marker at the 50%. I guess it's one tick above or below because that's in the half. And then I just wouldn't trade whenever the market was, oscillating around this. And what you'll find is that trading ranges usually are going to oscillate around that middle of that trading range. So bar 9 triggers the low 1 short, or you could argue low 2 if low 6, or since bar 5 was the low 1. So low 1, low 2, below bar 8. Triggers on bar 9. Am I selling bar 9? I probably wouldn't. I think we're probably just going to go sideways here. And I think 7 and 8 are strong enough for a second leg sideways to up. Outside up on bar 9, probably better for the bulls than for the bears. But again, bears see a bear trend from bars 2 through 6, and they see 7 and 8 as the first leg and 10 as the second leg in a 2-legged correction, and they want a swing down. Bulls see this as the bottom of a trading range, and they're looking for a swing up. So for me, I think, the bull argument's a little bit better because it's probably a trading range open. So probably buyers not too far below anything and sellers not too far above. You can see we traded below bar 10 during bar 11, but buyers below, so it's a good bull bar, which to me indicates that, I would argue it's more of a low 2, but some traders would say since we traded below 6, that's a low 1. We traded below 8, that's a low 2. And now we're trading below 10, it's a low 3. Either way, I think that there are buyers below the big bull bar, and we have a trading range open. So a lot of traders bought below bar 10, scalped out back around the close of bar 10, probably during bar 12. An inside bar on 12, but probably sellers not too far above, probably buyers not too far below. I'd rather not buy above a bear bar towards the top of the tight trading range, and I'd rather not sell below a weak bear bar at the bottom of the range. So I'm definitely stuck on the sidelines here. 13, a doji bar. So now 11, 12, and 13 are doji bars, essentially. 12 is not an actual doji, but it's close enough that you could consider it a doji, and it will probably behave like one. Do I want to buy below 13 or sell below 13? Not really. I would rather just be flat and wait for the breakout. And I don't think 14 is the breakout. When you see 14, the first thing you have to ask yourself is what are we breaking out of, right? So it's easy to see 14 and argue we've been always in short the whole day from bar 2 through bar 6. And it's valid to think that we probably have been relatively always in short once maybe bar 4 or 5. And, we never really did flip to always in long. But at the same time, traders, this looks a lot more like a leg in a trading range. And if you're selling below 14 or the close of 14, you have to ask yourself, is a big bear trend going to start with a bar like bar 13? Probably not. Big bear trends don't usually start with doji bars. They usually start with good bear bars. So if you're selling below 13 or below 14, you're basically banking on 13 being the signal bar for the swing. And that's pretty unusual. So I don't think it's all that good of a sell. 15, a big bull bar closing near its high towards the top of the tight trading range. It's a good enough bar that I think it flips the market to clearly always in long. So I think good for the bulls. I think it's okay to buy above 15. You're hoping for a swing up. The daily chart was relatively neutral coming into the day. You can see we had essentially a high 1. So I thought it was reasonable to think we might get a little bit of a bounce or we could get a bit of a sell-off. So I wasn't really using or thinking about the daily chart too much today because it didn't seem to have any clear bias in either direction. So I was expecting sideways overall. So, 15 is probably a reasonable buy, betting that we get the swing up. But at the same time, if you're expecting a trading range day, and the context for a trading range day is good on the daily chart, then you probably have to think that we're going to end up going more sideways. So you can buy above 15, but we might have to get a pullback before we rally. Follow through, especially because you're trying to break out of a tight trading range. Follow through on 16. It does close above the high of the tight trading range, which is the 10 high, it's closed above the moving average, which is good for the bulls. But at the same time, it has a big tail on the top, and that's not what you want early in the rally. You want to see 16 being a big bull bar closing near its high, and instead it's a smaller bull bar. 17, a bear bar closing somewhat near its low. It's a wedge with the highs of 7, 10, and 17. Do you want to sell below 17? I think you can, since it's a wedge, but you're expecting two legs sideways down. You're not expecting, a giant bear trend out of this. And 15 and 16 was strong enough for its own second leg up. So I don't think we're going all that far down if we do go down. And then 18, you can see, allows the bulls who bought the close of 16, they scale in during 17, and they're able to get out during 18. So I think that, I think it's always in long, but I think it's hard to be long up here. And if you are long, it's kind of hard to sit through 19 as well. You probably, I thought when you see 19 closing on its low, I had a couple different thoughts. Well, for one, I thought that the bears who sold below here, if you sell below 17, what are you expecting? You're expecting a second leg sideways to down from the wedge. And 19, you get it. You get your second leg sideways to down. If you're selling below 19, you're selling near the bottom of a buy climax, 15. You're selling near the 14 low, which is a magnet below, that we might have to test. You can see we tested it later in the day and then bounced. So we might have to test down to the 14 low, but there's probably buyers below 15. So I think it made a lot more sense to wait to see if 19 was, or 20 was a good follow through bar, rather than selling so low in what's probably a trading range. Additionally, your risk is really big, and traders don't want to risk that much in trading range days. And we might still be always in long from 15 and 16. 19 might have made us always in short, but it's not really all that clear. So you're selling with big risk in the middle of a tight trading range, an area where we went sideways for a while when it's not really all that clear. So I think it's hard to take a trade like that. If you're a bull, you knew we were probably going to go sideways to down. 19 is a deeper pullback than you probably wanted to see. And oftentimes in trading ranges and on trading range days, the pullbacks are a lot deeper and more uncomfortable than you want them to be. So I think 19 is another sign that we're in a trading range. 20, a bull doji bar. It's bad follow through for the bears, but it's not exactly what the bulls wanted to see to buy above. They were hoping for a good bull bar closing near its high and a breakout pullback buy, but instead we get a doji bar. 21, you can see tested back to the close of 19. 19 was such a strong bar. I think we'll test back to the low of 19 at some point today. But a lot of the bears who sold 19 disappointed 20, just basically exited on the close of 20, and that caused the rally on 21. 22, an inside bar. It's a high one buy for the bulls, but it's a bear bar, so it's really not all that good. But I don't really want to sell it either. I think we are probably always in long, but I don't think anything is very clear right now. 23, a bull bar closing near its high, a big tail on the top, a tail on the bottom. It's follow through for the high one, but we should test to the bar 22 high, so it's really not ideal to be doing anything. And you can see we get a doji bar 24, just a real lack of follow through or commitment on either side. A big outside down bar 25. Do you sell 25? I probably wouldn't. You're selling again towards the middle of the trading range, so you rather look for a small bar to sell towards the top of the trading range. 26, bad follow through for the bears, and more bad follow through 27. But as if I'm a bull, I'm not buying above here. A doji bar 28, so we end up getting an II pattern 28, 29, and again, to me, that's just breakout mode. We tried to break out to the upside on 30, but we failed and got a reversal down 31. We are slowly drifting higher, but we're not going higher that much that fast. And something else I thought was, well, it wasn't great to sell the close of 14. You probably could have, or it wasn't necessarily reasonable, but some bears do sell and they scale in higher. Same thing with 19. Same thing with 25. These are all bear bars that are reasonably decent. So one of these reversals is going to end up working if we keep getting these types of closes. And if it does end up working, this is probably a trading range day, not a bull trend day, which we already know either way with all these doji bars. So I thought we were probably going to test all three of these levels at some point today. So 31, a bear bar closing near its low. Yes, it's a wedge. You could say 1, 2, 3, or 1, 2, 3, but that doesn't make as much sense. I thought the wedge was something like 7, 25, 31. But there's a lot of ways to draw it. As long as you can tell it's a couple legs up, and we're probably going to start to go sideways to down pretty soon. But the problem with selling 31 is you just had 5 bars without a bull close, and a 5 or without a bear close, and we're in a 5-bar bull micro channel. So if you're selling 31, you have to realize we're probably going to get one more leg up from this move. And one of the things you can do is you can sell 31. You can put a measured move up of 31 plus 1 or 2 ticks. At that point you're up here. You might as well just use the high of the day. But you can sell, put a stop maybe at the high of the day or 1 or 2 ticks above the measured move up of the bar, and you can scale in more. So you sell here, you would scale in more above the high of 31. And if 33 had triggered, or if 34 triggered above 33, you would just get out since it's such a strong bull bar and a possible breakout. But instead, it trades all the way back down, and those traders use the opportunity on 34 to exit. So they sell, they scale in higher, knowing that this is strong enough to probably get one more leg sideways to up, and we do get it. And they're probably ready to exit here, which is why, and a lot of bears know they're ready to exit here. So bulls are ready to buy, and bears are ready to exit, except instead, a lot of algorithms sold the close of the bar with low risk, trying to get the market to head back down to here and force a trading range day. That's exactly what happened. So 32, bad follow through for the bears who sold 31. Again, relatively expected. If you're selling below a bar like 31 to get bad follow through on 32. If you buy above 32, I probably wouldn't. I think you're buying too high. Again, there is something to be said for the bull bars have been working so far today, a little bit more than the bear bars, but everyone on stop order seems to be getting trapped today. So I didn't really want to do anything. 33, a huge bull bar. It's a breakout attempt. It's a bull surprise. Breakout above the high of bar 17. So this whole thing is some sort of triangle. And we're getting a breakout attempt above it. Probably relatively 50-50 if it works. Do you buy above 33? But you probably can, but it doesn't end up triggering. And you can see instead traders sell the close, and that causes 34. 34, even more convincing that we are probably in a trading range. When you see that, I think got to be thinking maybe we'll get back down to the 14 close. Additionally, we have not broken out of the 18 bar range yet. 90% chance on any given day that we break out of the 18 bar range. And I still think it's probably, maybe it's only like 80, but it's probably pretty close to that level that we break out because the daily range is so small. So whenever you see a daily range that's, we're in the early stages of the afternoon and it's a 15-point range, you got to know that the range is probably going to at least double. So reasonable to be looking for that if and when we do get a breakout. Occasionally, every once in a while, maybe once a month or something, you'll get a day or maybe once every 2 months, you'll get a day where it does this and you sit and wait for the breakout all day and it just never comes. But those days are a lot less often than the days where we end up getting the breakout. 34, a bear bar triggers the sell below 33, but it's not a good sell. You could argue some sort of wedge, but I think just, to dumb it down, I think trading range and we get a big bear bar. So I think trading range, and we're relatively high in a trading range, but I don't want to sell down here because big risk. I want to sell a pullback. 35, a bull bar closing near its high. You know that the 33 close is probably going to be a magnet because it was such a big bull bar and some bulls bought the close and they should be able to get a second chance to get out. So we might have to rally a little bit. 36, a bear bar, but not really all that good. I don't think. Let me just actually look at something real quick. So the bulls who bought the close of 33, maybe they scale. There's a 60% chance if you're in a trading range, if you buy the close of any given good bull bar or sell the close of any given bear bar, and you scale in, it's going to get back to your initial entry price. There's an 80% chance that if you buy the close of any given bull bar, like 33, and you add above the bar the next bull bar, or any bull bar really, like 37, 80% chance you're going to get back to your entry price. So figures, same thing with bar 49. You buy above it, you add on maybe 60, 65, right? And you were able to get out 80% chance. So, you could make the argument that, even, as high as here, maybe some traders might argue, I don't know if this is true. I'm kind of just speculating, but this is probably too far away, but I think you could buy above 65 thinking it was reasonable to buy up here and 80% chance we get into this area. So I think that might be why we bounced so quickly on 66 because the probability was really high. 38, a bull bar closing near its high. Good for the bulls, but for me, it might just be a second leg up. And 34 was strong enough for another leg down. So I think still big trading range. Bad follow through for the bears on 39 and an outside down bar on 40. Am I doing anything here? I wouldn't. 39 double top, 34, but not really all that good. Neckline 37. And then an inside bar 41. So it's an IOI pattern. It's a breakout mode pattern. but I'm not really willing to sell below 41, and I'm not really willing to buy below bars this high up in a trading range. I don't take limit order trades anyways, but if I was a limit order trader, I don't think I would want to buy this high up in a trading range. So I would not personally buy below 41. 42, follow through for the bears, but tail on the bottom. I would rather wait. Again, the daily range is only 15, so there's not really a rush. If you wanted to, you could set orders. When the daily range is this small, you can just set in order to sell one tick below the bottom of the range, and in order to buy one tick above the top of the range, because you know that 60% chance that we're at least 60% chance we're going to double the daily range, and probably point being, if you sell the breakout and you put in order to take profit a measured move down to the range, probably 60% chance that this is going to get filled before you get stopped out. Occasionally it'll reverse up and you'd have to sit through something really difficult. But I think the premise is pretty strong. So a lot of traders will just sell the breakout of the 18 bar range. So 42, a bear bar closing near its low. Good for the bears, but again, I'd rather wait for the follow through. And you get follow through on 43, but a conspicuous tail on 43. And you can see we're testing right to the 14 close, where some traders who sold are going to be really disappointed in how their trade has turned out. And so they'll be looking to exit down here. And that's what's causing the rally on 44. Am I buying above 44? I probably would not. I think 44, really big bar, really big risk. So probably going to be more sideways rather than rather than up. And you get disappointing follow through 45. I thought we might have to get back to the 41 low since it was bad sell signal bar, so it should get tested. But instead, we get buyers below 45 during 46. Probably a second leg sideways to up from 44 and 45. 47, another bear bar, but I don't really want to sell 47 or 48. My viewpoint on this was the bears who sold the close of 43 are disappointed in this, so they're going to try to get out if we get down here. And 44 and 45 is way too strong. I don't think that this is the start of a bear trend, and then you can see 44 and 45 back into the middle of the trading range and still think your breakout is all that valid. So I think had I shorted anywhere in here, it's really hard to hold. And that's why I wouldn't sell 48 either, because you're selling, lower in the trading range. We keep getting pretty good bull bars. Another hint of the rally late in the day was we kept getting good bull bar, good bull bar, good bull bar, good bull bar, good bull bar. So, and another good bull bar. So when you keep getting that many strong bull bars early in the day, it's easier for traders to think that we might end up getting a reversal back into the range. So I wouldn't sell 47, 48, 49, outside up. Good for the bulls, but right on the moving average and in the middle of the trading range. If you bought above 49, this is one of those areas where I was talking about, what's your premise? And your premise is that this is going to be the breakout. If you're buying above 49, you're buying above thinking that we're about to start the rally and we're going to get a measured move up from the bar 7 low to the bar 1 high, and then, a measured move up from this. But it's probably not going to happen. The reason it's probably not going to happen is because it's a trading range day and you're buying in the middle of a trading range day after 46, 47, 48, which is 3 bear bars. But there is still a chance that 50 becomes a huge bull bar. So it's probably theoretically okay, or probably is okay to buy above 49. But we were 3 minutes into bar 49 and it was still sitting around your entry price. When you see that, I don't think that's a good thing. And I think a lot of traders would just choose to exit. So, and especially on the close of 50, when you see that, I mean, it's not the follow through bar you wanted. And a lot of times, you can feel the edge disappear. You buy above 49 thinking, okay, maybe we get the good bar, and then you don't. And then a lot of traders anyways will sit and think, well, I don't know, maybe it'll go. But that's the wrong thing to do. When you see it and you don't get the follow through you want, you should just get out. And that's what a lot of traders do. They just flatten out the market, and that causes the bear bar 51. Bear surprise 52. Good for the bears. I'm surprised we didn't get back to the 50 low. So that's a set of trap traders. Can you sell below 52? Yep, it's a good sell. You are selling low in the trading range. That's true. But I think that the bulls have had a couple of chances, and this is a really good looking pair of bear bars, and this could definitely be the breakout. The problem is it didn't quite break out of the low. There is a little bit of a conspicuous tail, and obviously we've had a lot of good bull bars today. And you can see we got kind of a disappointing bar on 53. It didn't close on its low. Why? Because the bears who sold 52, look, they were able to make exactly 5 points. So they sold 52 and they thought, well, trading range day, so I'm probably going to still scalp. And it's a valid strategy, because if you've been scalping all day, it doesn't always make sense to try and be the first bull or the first trader to make a swing, right? if it's early in the range of the day, it's different because early in the day, nothing has been established yet, and so traders will be more aggressive trying to take swings. But if it's been a trading range for 52 bars, a lot of traders will just continue scalping, and that's why we got the disappointing bar on 53 because the traders they sold 52, they got their 5 points and they just exited, and that caused the bounce on 53 rather than holding and hoping they get a swing. 54, it's a low one short for the Bears, but it's really not a very good low one short. So it's better buy below 40 or below 54 than a sell below because Bulls will bet on a trading range because this is not how the Bears wanted this breakout to look. So Bulls will bet, yeah, Bears don't want to sell the low one short. And if I'm buying below 54, I'm buying really low in this trading range. So this is good for me. So they'll take the buy below 54. And the thing is, if you bought below 54, you could scalp out with 5 points at the high of 55. So the Bulls will buy below 54 and exit up here, which is why the rally up here was not all that strong. Something else that's interesting to note, though, is, I didn't buy above 55, but some traders might because a 5 point scalp above 55 is exactly at the 50 low. So we didn't get there. We didn't go race from here to here, but I don't think it was unreasonable to think that we might have gotten a vacuum test of the 50 low because it's exactly a 5 point scalp, and the computers, made it that way for a reason. But obviously, there's always a probability everything works and everything fails. 56, disappointing follow through bar if you had bought above 55. So a lot of traders choose to exit, and we get 57. 57, I would say 54 was the low one short, and for Bears, 57 is the low two short from the moving average, and you're selling a low two in a bear trend. But I think lower probability that this works. I maybe like 30% chance this turns into what it did. I thought more likely we were going to start to go sideways, especially after how strong 55 closed, and you have 3 straight bull closes. 58, follow through for the Bears, but it's really not all that good. And I thought 59 was a really important bar. It closed near its low. Can you sell 59? You definitely can. My only problem with it was trading breakouts hadn't been all that successful so far today. So you can sell 59, but I think if you sell 59 and 60 is a bull reversal bar closing on its high, over here, then you probably got to not only get out, but reverse to long because we could easily start a bounce and go close these gaps or, touch this 50 low. So I thought that it's okay to sell 59, but you have to know what you're doing because you're selling really low. So you have to be ready to exit, should that arise. And instead you get a bear bar closing near its low 60. Now it's sell to close. You have a breakout. The Bulls want a wedge 43, 53, 60, but it's not as credible after the 3 really strong bear bars. 61, a big bear bar closing near its low. Good for the Bears, probably going at least a little bit lower. So 61, a big bear bar closing near its low. Do you sell below 61? You can, but it's just really climactic. So you have to keep in mind that this could be getting towards the end of the sell to close because 61 is such a climactic bar. Followed through on 62, but a big tail. And you can see we got a pullback on 63, and Bears sold above 60, 62, scaled in maybe a point or two higher. I don't know if you sold the high tick here, you could have made 5 points, basically exactly. 63, a low one short, but it's not really that good because it's a bear bar closing near it's a bull bar. I meant to just say it's a bull bar. So it's a weak low one short below 63, probably buyers below, which we got on 64 and the reversal up. Double bottom, 62, 64, neckline 63. Do you buy above 64? I probably wouldn't. I think that it's not really a very strong bar, and it's very possible that we end up getting something disappointing for the Bulls and continue to go down at least a little bit lower. However, I thought that the tail on 64 was enough for the second leg sideways to down for the Bears. So if you're wondering why we rallied and quote unquote you think we didn't get a second leg, well, your second leg down was the tail on 64. 65, a bull bar, a big tail, or a tail on top and a tail on the bottom. But for me, I didn't buy above 65 because I was short and I exited above 65. But since I was a bear exiting, it was probably reasonable to establish a long for at least a scalp. So a reasonable buy, I think, above 65, betting that we at least close the gap with the 53 low. And like I said, 80% chance you get to the midpoint of the 54 high and the 65 low, something like that. So big follow through for the Bulls, 66. Good bull bar closing near its high. Do you buy above 66? I think it's okay to, again, betting that we're going to go just start to rally and get good follow through for the Bulls and maybe close, get back to the 56 close. I thought the 56 close was the most obvious magnet. I thought 51 or the 50 close was obvious as well, but I didn't think we would get there with the time that was left in the day. 67, bad follow through for the Bears or for the Bulls, and then 68, a bull bar closing near its high, but I'd rather wait. 69, a bear bar with a big tail on the bottom, but I thought the Bulls had a better chance to go here. You can see, some Bulls probably would exit below 67, but instead they bought the close and we got the rally. So Bulls were hoping we were going to rally straight from here, but instead disappointing bar 69. So a lot of traders use the rally up on 70 to exit their longs around the 68 close. 71 follow through for the Bulls, but it's really not all that good since it has overlapping tails, and it could be 3 pushes up, 66, 68, 71. I think it's okay to buy and okay to be long, but you have to keep in mind it could be a third leg up in a trading range and a big tail 71 overlap. 72, good follow through for the Bulls, but then you get the big tail on the top, and now this looks like some sort of wedge. Huge bar, huge risk. I probably wouldn't sell the close. Instead, Bulls buy the close, and you get good follow through 73. Disappointing bar 74 for the Bulls. I think I would exit my longs below 74. So I think it's mostly traders exiting on 75. You can see we touched the 73 close during 75, and then follow through 76, but again, not all that good. And I thought we were going to close a lot of the quote unquote gaps, but touch the reasonable entries. And then obviously once we started to go sideways here, I didn't think it was as likely. But you can see towards the end of the day, that's why we got this big rally, 77, 78, because we're trying to touch these closes. For stop order trades, not a lot of great ones earlier in the day. Probably 15 is fine. I don't know, maybe you could sell 17 for a second, like sideways to down, but you probably got to find a way to get out down here. Realizing that 19 is big bar, big risk after these pretty good consecutive bull bars, so it might be more of a buy the close bar, 19 than a sell the close bar. And, the daily range is so small so far that rather than sell 19, you can just see if 20 is a big bear bar too and then sell that. You could sell 31, I think, with the wide stop. I probably wouldn't do anything else until 52. Most traders scalped. Hard to stay short through here, trading always in. I would not sell 57 personally. I wouldn't sell anything in here until he got higher probability, like 59 or 60 or 61. Probably okay, 65, 66, maybe 71. And I don't trade this late in the day. On the daily chart, disappointing follow through for the Bulls for this high one, but it's about what you'd expect. I'm going to turn on extended hours today. So I like to look at the chart with extended hours all the time. So disappointing follow through after the bear surprise down. It's probably good enough for a second leg sideways to down, but this is about what you'd expect if you got this bar. You'd expect something disappointing. So theoretically, if you were a daily chart bull and you had bought above this bar, what was your argument? Well, you're hoping, two-legged pullback or some sort of wedge pullback, and we're going to stay above moving average and continue to rally. You still have a chance of that, but tomorrow needs to be a really good bull bar, and it needs to happen pretty quickly in the next day or so. More likely, I think traders, if they bought here, they're disappointed with this, and they're going to use the rally to exit their longs, and we're going to continue to go sideways. We're probably getting back to this close. It's a new week. Bulls are hoping that we're going to continue up and that this is just a pullback in their bull trend, but they really wanted to see us last week close above this high. And so with the disappointing close, I think we might end up going a bit more sideways to down this week since bulls who bought here are exiting. The monthly chart, I think bears want to get the close down above the April high or keep it down above the April high so that it's not technically a breakout. This is really not all that great. Obviously for the bears, but I don't think it's all that great for the bulls either. This was a big enough surprise that we'll probably get its second leg sideways to down. So I don't know. It depends. The bears are trying to put as much of a tail as they can on this bar so that they can claim we're going to be going more sideways for the next month or two. I don't know if they're going to get it. It's pretty late in the month, and this is a reasonably big bar. So we would need something pretty dramatic from the bears, which we probably will not get. So the monthly chart will probably close looking something like this. It's today.